In this episode, we're going to look at how a company can increase its dividend even though its earnings are down. Hi, I'm Ken Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover 5 topics. And in the first topic, we're going to talk quickly about Franklin Resources. This is the company we'll be using in our example for today's episode. Then we're going to take a look at the company's recent decline in earnings. Then we'll look at why the company has been increasing its dividend. We'll look at 2 other examples and see how those companies have performed. And then finally, we're going to decide whether or not it is worthwhile to invest in Franklin Resources as of this recording. Let's get started with our first topic, the company itself. So Franklin Resources trades on the New York Stock Exchange. The company was founded in 1947. They have a little over 10,000 employees and a market cap of $10.7 billion. This company is an asset management holding company. It provides services to individuals, institutions, pension plans, trusts, and partnerships. It launches equity, fixed income, and balanced mutual funds through its other companies and subsidiaries. Now let's take a look at the company's history of recent earnings. So what you're going to see on the screen right now is the last 5 years. And the EPS is the earnings per share. So that's how much money the company is making, and that's how much they reported each year. So if we take a look and we go back to 2020, you can see that the company's EPS was $1.59. The following year looked like it was a very good year because the earnings went up to $3.57. And then the year after that, in the year 2022, you can see that the earnings actually declined to $2.53. The year after that, the earnings went down again to $1.72, and then they went down again to 85 cents in the year 2024. So that's what the company reported. So if we look at the 5-year history, we can see 1 increase in earnings, and then we can see 3 declines in the earnings per share for this company. So that doesn't look too good. If we look at this graph, you can see that since 2021, the earnings have been declining. So what has the company been doing with its dividend? Now remember, the dividend is what the company is paying to you, the shareholder, from its profits, from its earnings, right? So we've said this in previous episodes. If a company is paying a dividend of $1 per share and you own 1,000 shares, you're going to get $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. So in this example, the company is going to be taking money out of its earnings and then paying a portion of that to the shareholders. So let's take a look at the annual dividend. So we're going to start again back at 2020, and you can see that the company paid a dividend of $1.09 to the shareholders. The following year, they increased the dividend to $1.13. After that, it went up again to $1.17. Then it went up again to $1.21, and then it went up again to $1.25 in 2024. So you can see that over the last 5 years, the dividend has been steadily increasing. And if we look at the payout ratio, which is simply the dividend divided by the earnings per share, expressed as a percentage. So you can see that in 2020, the payout ratio was 69%. And what that means is the company paid out a dividend of 69% of its earnings was paid out as a dividend to the shareholders. The rest of the earnings the company kept and reinvested back into the company to grow the business. And then the following year, we can see the payout ratio was 32%. And that's a healthy payout ratio. It means the company is only paying 32% of what it earned, the rest it's keeping. It means it has the ability to increase the dividend in the future if it needs to. But then what we see is the dividend, the payout ratio went up to 46%. After that, it went up to 70%. And then in 2024, now keep in mind, the company only earned 85 cents a share, but it paid a dividend of $1.25 to the shareholders. That represents a payout ratio of 147%. And so as a dividend investor, this is a little risky when we look at this, because how is the company able to pay the dividend, and in this case a dividend of $1.25, when it only earned 85 cents that year? So this is going to be a cause of concern because the payout ratio has been steadily increasing since 2021, even though the earnings have been steadily going down since 2021. So now let's take a look at some of the reasons why a company like this would increase their dividend even though the earnings are dropping. So you can see up on the screen here, there's 4 possible reasons of why a company would do this. And so we're going to go through each one one by one. So let's start with reason number 1, strong cash flow from operations. So if a company has that, it allows the company to distribute more cash to the shareholders, even though its earnings are lower. So is this the case with Franklin Resources? Let's take a look at the cash flow. So we're going to look back at the last 2 years. So you can see that the free cash flow in 2023 was roughly $940 million. But then in 2024, that dropped to $794 million. So the free cash flow has actually gone down. And if we look at the cash flow per share, in 2023 it was $1.92, and then in 2024 it was $1.56. So again, the cash flow per share has decreased. So this is not, to me, this is not a valid reason for the company to increase its dividend. So let's take a look at reason number 2. And this could be a confidence in future performance. The company might believe that the decline in earnings is temporary and that the future earnings will rebound. And so they have hopefully crunched the numbers and they've looked at it and they are confident that their earnings will come back up this year to cover for the increase in dividends. So this is a possibility. Number 3 is attracting investors, right? A higher dividend, of course, is going to attract new investors and retain existing ones, especially if the company's stock price is under pressure. So is that the case with Franklin Resources? Let's take a look. So if we look at the last 8 years, this is the stock price history, you can see that the stock price has not done so well. It's on a steady sort of decline. It goes up and down, but overall in the last 8 years, it's been on a decline. The stock price was over $48 a share, and as of this recording, it's close to $20 a share. So the share price has been under pressure and declining. So this might be a reason why the company may increase the dividend to attract new investors to prevent the stock price from dropping any further. And then finally, reason number 4, it could depend on the company's dividend policy. This company may have a policy of maintaining or gradually increasing dividends to show stability and reliability to investors. So is that the case with Franklin Resources? I think it is, because if you take a look at it, this company has had 49 years of consecutive dividend increases. So if they want to keep that streak of consecutive dividend increases, well, then they're going to have to keep increasing dividends, even though the earnings have continued to drop. Now, this can only go on for so long, but we're going to get a little bit more into that later. And so let's see, if we look back at the 4 reasons to increase their dividend, I don't think reason number 1 is the case here, because we looked at the cash flow and cash flow has been decreasing, not going up. But reason number 2, confidence in future performance, maybe the company might believe that. The company may want to attract new investors and keep existing ones, so that's reason number 3. And the company may have a dividend policy of, we want to increase dividends every year. So that's reason number 4. Now let's take a look at 2 other examples of other companies before we finally answer the ultimate question of whether we should be investing in Franklin Resources. So let's take a look at 2 examples of companies that have had similar situations. So we're going to look at Walmart and Visa. So if we take a look at Walmart, we're going to go back to 2019. You can see that the earnings were 75 cents a share. Then the year after that, the earnings went up, so $1.73, so that's good news. But then the year after that, the earnings actually came down to $1.58. So that's never good news when the earnings drop. But what happened to the dividend? You can see that the dividend has gone up consistently every year. It was 71 cents back in 2019. Then they increased to 72 cents, and then they increased to 73. And in fact, the dividend has gone up every year since then. So how has the stock price performed during this period, especially between the year 2020 and 2021? Earnings dropped. So what happened to the stock price for Walmart? So if we take a look at the Walmart chart going back to 2019, you can see that there has been a steady increase in the stock price. In fact, it looks like the stock has done really well. It was trading below $50 a share back in 2019. It's now more than doubled at over $102 a share. So in the case of Walmart, the temporary drop in earnings did not hurt the company. Now let's take a look at Visa. Again, we're going to look at the same time period between 2019 and 2021. You can see that the company in 2019 earned $5.13 a share. In 2020, the earnings dropped to $4.71. And then the year after that, they went up again. What did the company do with the dividend? Again, same as Walmart, they've increased the dividend. In fact, they've increased it much higher than Walmart did. The dividend in 2019 was at $1.05. Then it went up to $1.22, and then went up to $1.34. So same thing, we're going to take a look at the stock price for Visa and see if the drop in earnings, did it have a negative impact on the stock price? So here you can see again with Visa, the company has done really well. There was a drop in 2019, you can see in the stock price, but after that, the price has continued to go up, up, and up. It was back in 2019, it was around $160 a share. Now it's more than doubled to $351 a share. So in this case as well, Visa seems to have done pretty well since 2019. So both Walmart and Visa seem to have done well. It didn't hurt in the long term, the companies, given the decline in earnings. And we see that with other companies as well. You know, you can, if you look at a 20-year period, you may have 1 or 2 years or 3 or 4 years where the earnings drop, but then they come back up again. And the earnings drop, you know, could be related to a company was doing a major acquisition, so their costs went up, or they had to do some restructuring and the costs went up temporarily for that year, and then the earnings come back up. So that's what we're looking for when we're investing in companies, is the long-term trend. Is the company doing well in the long term? Is it profitable? Are the earnings going up? If so, then that's good. Then we can tolerate, you know, 1 or 2 or 3 or 4 drops in the earnings over a 20-year period. So now let's get to our ultimate question. As of this recording, should we be investing in Franklin Resources, and should we consider it as a stock to invest in? Because it is a dividend stock. So that's the big question. So to help answer this question and to make it simple, we're going to use the 12 rules of simply investing. And we're going to go a lot faster because what we're going to do is we're going to focus on rules number 5 to 11 because those are quantifiable. So those are easy. We can take a look at it and we can see if a company passes or fails rules number 5 to 11. And I refer to those as the simply investing criteria. And rather than calculate those values ourselves manually, you could do that. We talk about that in the Simply Investing course. So you could do that with any company anywhere in the world. But for now, in this episode, we're going to go straight to the Simply Investing web application, because the web application applies the SI criteria to over 6,000 companies in the US and in Canada every single day. So we're going to go in. I've already done this ahead of time. I've gone into the Simply Investing app. I've done a search for Franklin Resources, and I'm going to share with you the numbers right now. So if we look at rule number 5A, the 20-year average EPS growth must be 8% or more. And for this company, it is sitting right now at 10.4%. So that's good. It passes rule number 5A. Rule number 5B, we want to make sure that over the last 20 years, the company has had at least 8 or more increases in the earnings. And again, we see that they've had 10, so this is good. The company passes rule number 5B. Let's go to rule number 6. The 20-year average dividend growth must be 8% or more, and we can see that it's sitting at 55%. So that's also good news. Rule number 7, the payout ratio must be 75% or less. And in this case, as of this recording, the payout ratio is at 150%. So that's not good. The company fails rule number 7. Rule number 8, long-term debt to equity ratio should be 70% or less. In this case, it's 94%. So the company fails rule number 8 as well. Rule number 9, we want to make sure that the current dividend as of this recording is higher than the previous year dividend, and it is. So they've increased the dividend again in 2025. Rule number 10, does the company actively buy back its shares? And so what we do is we look at the number of outstanding shares today compared to the previous year. And in this case, the answer is no. There's more shares outstanding instead of less. Rule number 11A, the P/E ratio must be 25 or less, and we can see it's 24, so that's good. Rule number 11B, the company must be undervalued, priced low, and it is. If you're interested in figuring that out, I'd recommend going back, watching episode 1, where we covered rule number 11B in detail. And then rule number 11C is to make sure that the PB ratio is 3 or less, and in this case, it's 0.86. So that's good. The company passes rule number 11C. So you can see I've highlighted up on the screen the 3 rules that the company currently fails. Rule number 7, rule number 8, and rule number 10. And again, so this is the Simply Investing criteria, rules number 5 to 11. And you can see there's 10 of them because rule number 5 is in 2 parts, A and B. Rule number 11 is in 3 parts, A, B, and C. So there's a total of 10. If a company passes all of the 10 criteria, it gets a grade of 10 out of 10. So you can automatically know what the grade is going to be for Franklin Resources. And if we go into the Simply Investing web application, right there you can see that it gets a grade of 7 out of 10 because it fails the 3 rules. So should you invest in Franklin Resources today? Again, as of this recording, because when you watch this episode sometime later in the future, things will change and you'll have to apply the Simply Investing criteria and the 12 rules all over again. But as of this recording, you can see it does not get a 10 out of 10 in the SI criteria, and that's what we always recommend, especially for investors, beginners starting to invest. You always want to make sure you're investing in a company that passes all of the 12 rules of Simply Investing, not just a few of the rules. Has to pass all of them. So because of that, this is not a company today that I would invest in because we saw the 3 failures in the SI criteria. So remember, our approach is a long-term approach to invest in quality, dividend-paying stocks when they're priced low. So not just any stock, it has to be a quality stock, and not just at any price, it has to be priced low. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock and if it's priced low? Well, for that, I've created the 12 rules of simply investing. We've already talked about them in the episode, but we didn't cover all of them, so I'm just going to go through that right now. And remember, a company has to pass all of the rules for you to invest in it. Rule number 1, do you understand how the company is making money? If you don't, skip it. Move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid companies with recent dividend cuts. Rule number 10, does it buy back its own shares? Rule number 11, is the stock price low? And rule number 12, you have to remember to keep your emotions out of investing. Now, to make this all simple, easy to apply, we have an all-in-one solution. We provide you with the dividend investing course that covers everything in detail and access to our web application. The course is divided into 10 modules. It's a self-paced course. In Module 1, we cover the investing basics. In Module 2, we cover the 12 rules in detail with real-life examples. Module 3, you'll learn how to apply the 12 rules. Module 4, you'll learn how to use the web application. Module 5, we show you how to place your first stock order step by step. Module 6, show you how to build and track your portfolio. Module 7, you learn how, when to sell, which is just as important as to know when to buy. Module 8, how to reduce your fees and risk, especially when it comes to mutual funds, index funds, and ETFs. Module 9, we give you your action plan to get started right away. And Module 10, we answer your most frequently asked questions. And the app, like I mentioned before, applies the SI criteria to over 6,000 companies in the US and in Canada every day. And you can immediately see the data that you need to make a determination if this is a company that you're interested in investing in, or if this is a company that you should skip for now. If you're interested, you may want to write down the coupon code. We have one for all of our viewers, SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. If you enjoyed today's episode, be sure to hit the subscribe button, hit the like button as well. We have a new episode out every week. For more information, take a look at our website, simplyinvesting.com. And thanks for watching.